Welcome to Barchart's series of webinars designed to educate you about a variety of market concepts, to inform you of the pages and tools Barchart provides related to these concepts, and finally, they offer you some trader's insight to help you make a more informed investment decision. Today's subject, using Barchart's implied volatility rank and percentage page to find trading opportunities. The price of an option is determined by 6 drivers: the underlying stock price, the strike price, time to expiration, dividends, interest rates, and implied volatility. Implied volatility's impact on options pricings can be meaningful, even if the underlying security price doesn't move. Though the reality of market mechanics, implied volatility is the market participants' expectations of price movements, and they are notorious for being wrong. So in other words, volatility options traders are willing to take contrarian positions opposite of the populace belief, which could be against the trend, knowing full well that the masses are wrong more times than right. Hello, everyone. My name is John Rowland, and I'm Barchart's head of trading education. And today we're going to examine Barchart's IV rank and percentage page in an attempt to spot where implied volatility is out of line and how to take positions that would profit from the masses' distorted misinterpretation. Say that 3 times. Now, before we get started, please welcome my partner and our moderator, Barchart's project director, Jean Baker. Hello, Jean.
Hi there, John. How are you?
I am doing fine in this beautiful day. How about you?
I'm doing great. Hey, so I always like to check and see what today is. Today, the national day today. And today is Chaos Never Dies Day. Did you know that?
No, I did not know that.
Yeah.
I mean, I know that chaos never dies, but I didn't know that chaos had its
Today,
own special day.
special day today, Chaos Never Dies Day. It's dedicated to enjoying the chaos in the world around us. So there.
So I do know this: in Chinese philosophy, there's 2 definitions to the word chaos, and one of the definitions is that chaos is another word for opportunity.
Hey, yeah, I guess you can look at it that way, can't you?
So every day is an opportunity. So I like that philosophy, huh?
All right. Well, let's get on with some chaos, all right?
Okay, that's a good point. I love that. All right, good job. All right, just remember today that it's for educational purposes only, and decisions to buy, sell, or hold or trade commodities, securities, or options, or any other investment involves risk and best made on the advice of a qualified financial professional. And options trading is not for everyone. And volatility trading, if not understood correctly, could lead to the loss of principal and or greater. Now, under no circumstance shall we be liable for any loss or damage you or anyone incurs as a result of any trading or investment activity that you or anyone engages in based on information or material received through barchart.com and our services. So, with that out of the way, what is exactly this term volatility? So there's 2 definitions we're going to concentrate on. One is called historical, and which represents the annualized standard deviation of price variance of daily price changes. That's the definition. But in other words, how much, based on past price action, did the security move, vibrate, fluctuate during a defined time frame? Now, historical volatility is not a predictor of future price movements, but it's just a statistical calculation based on price data. And we're going to use this only in a comparative analysis, a kind of a measuring stick or an assumption that what was in the past history might give us guidance for the future. And then we have implied volatility. Now, implied volatility is the market's prediction or expectation of how much or how fast a security will move over the life of an option. As I mentioned in the introduction, markets overestimate high implied volatility or underestimate low implied volatility. And this is going to be the basis for us for seeking out these volatility trading opportunities. Now, depending on where implied volatility is compared to the past, applied volatility to applied volatility, but also that comparison to historical, will lead us on a path of discovery of what type of strategy we might look for. So how are we going to use this, or how are we going to determine when the market is out of line, right? So we have implied volatility rank, which is just the at the money average implied volatility relative to highest and lowest values over one past year. Now, if the implied volatility is, let's say, 100%, it means that it's the highest level over the last year. And option strategies that look to profit from a decrease in the asset price or a reduction in implied volatility may be in order. And if the implied volatility is zero, then option strategies that look to profit from an increase in asset prices or a change, an increase in implied volatility may be in order. Now I'm going to reference this in a second because this definition I want to change just a little bit. But percentage or percentile implied volatility is just the number of days in a percentage where the implied volatility closed below the current at the money implied volatility over the last year. So first of all, let's talk about this concept of 0 and 100. Now, we don't necessarily are going to look for securities that have a 0 or a 100. I'm just telling you what those represent. What we might want to do is make our decision based on a value or a threshold that is above or below. For instance, let's say we'll look for buying implied volatility opportunities below a 15% or 10%, or looking for selling implied volatility opportunities above 85 or 90%. And the other thing that I want you to understand, and when I wrote this definition up, I took the bias from a bullish perspective. In other words, that we're always thinking in terms of the stock market is going to go up and stocks are going up. But we can think about it and think about what we're in the market that we're in now in a bearish market, that we could see these extremes of implied volatility when the market goes down. So not necessarily do I need to look for a decrease in asset prices when implied volatility is high. I could also look at a rise in, a fall in security prices, the opposite in, let's say, bear market scenarios, okay? I hope that makes a little bit more sense to you. I'm really just talking about implied volatility overall, not necessarily the direction of the underlying asset. So how are we going to apply this rank and percentage? So applied volatility are going to give us kind of this clue to if implied volatility is high or low. Now, at some point, you should be asking yourself, well, which is the better, right? Rank or percentage? Now, they both serve a purpose. But I believe that the determination is the absolute range for our implied volatility. So let me kind of give you some examples of what I'm talking about. For instance, let's say I have a stock that has an implied volatility range of, say, 35 to 50%. and the current implied volatility is 36. Now that's a small range, so that's going to give me a very tight percentile, right? A lot of, if I broke that into 100 pieces, right, very small percentile movements. But the rank, right, I could have many days, or implied volatility could be at the low end or the high end, and that could give me a different ranking compared to the percentile. Now let's assume in this scenario that our historical volatility is 38. So I have an implied volatility of 36 and I have a historical of 38. Now, if I'm looking to buy implied volatility, there is not a lot of price volatility movement, not price movement, volatility movement from where my current implied volatility is and where my historical. Again, that comparison. And even if I get an extreme movement in my implied volatility, from 35 to 50, yeah, it's 15 points, but maybe that would limit some of my opportunities, especially when I'm comparing that to our historical. Now, let's say we have a stock whose implied volatility is 35 to 100. And my current implied volatility is 36. Well, I have a wider range here, right? And my percentile now is getting wider, and that my rank might be a little bit more significant, especially if this stock has a historical implied volatility of 65. So that might give us a greater opportunity. So the range of our implied volatility is going to also help us a little bit on that aspect. Now let's flip this coin over. Let's pretend that we have a stock whose implied volatility ranges between 65 and 100, and the current implied volatility is 90, and my historical is 86. Again, I could have a high percentage or a high level of implied volatility, but maybe my rank is not as high because there has been more days and implied volatility days where we could be, say, are closer to the historical. So again, this might limit some of my opportunities. But determining the percentile of current implied volatility and where it falls in that range, and is that range wide or narrow, and how does that compare to a historical? So one of the things we can make an assumptions is if we have a wide range and we have a low percentile, then options are priced cheaply. If we have a wide range and we have a high percentile, then options are priced expensive. So low IVs, right? We're going to consider buying cheap premiums. So what are some of those opportunities? So we're going to make some assumptions here again. My decision to trade is going to be based on, am I looking for a directional move in my security, up or down, or I'm just looking for a movement in implied volatility, a non-directional movement. I don't care where the stock of the price is. Maybe the stock of the price is range bound, or I'm waiting for price to move after, let's say, a post-price shock event after the fact. So low volatility trades, these directional strategies, could be just as simple as buying a call or buying a put. Then we could move to the next level, debit spreads, like bull call spreads or bear put spreads. And then to the advanced or complex strategy, a long straddle, where we don't care where price goes, we just want price to move. We just want it to move up or down. Now, high implied volatility scenarios, right? If I'm in a high implied volatility environment, now one of the easiest strategies to do is a great opportunity is look for covered call strategies, especially if I own that stock, right? My stock is rise in price, the implied volatility is risen, I could sell a call that's above current price, collect a lot of premium, and that would be monies that I could put in my coffer. Also, lessen the sting in case the stock does reverse in price. But in extreme bear conditions, like we've recently had, selling naked puts, again, financing an opportunity to enter into the market. A more complex non-directional strategy would look to capitalize on high implied volatility in an anticipation that that implied volatility will return to that historical level. Now, a great example of putting these two concepts together of changing volatility opportunities is earnings. Now, typically implied volatility rises before earnings and then falls after. Sometimes you might have heard a reference to something called the volatility crush or the vol crush, the after the release of earnings. So an high implied volatility complex strategy, a strangle of a stock after the fact. In other words, buy the rumor, buy implied volatility, sell the news, sell the earnings report. Now, savvy traders look for those opportunities, buying in front of earnings and selling afterwards. Now, of course, technical analysis is going to be part of our process, right? It's going to help us enhance our potential price movements. Again, things like chart patterns or moving averages or trend lines, things like that. But also, we can use technical analysis to help us gauge past performance, again, as a guidance to price movement. And now we'll look at that in a moment. Okay, so that out of the way. Whoops. My computer is being a little funky on me. Okay, there we go. All right. So I'm going to go to options, and under the options page, we have our implied volatility rank and percentage, and I've already opened a tab for it, and this is the main page here. And let's kind of just go through what's going on in here. So basically, this page is basically laid out, or it's filtered by options volume. In other words, the highest options volume market will be the top of the list. So you can see across, you have the name of the stock, the last price, the change of the price of the stock, percentage, and absolute, how much options volume, our implied volatility. Now notice that in here, our implied volatility is represented by a green. That means that the implied volatility is greater than it was yesterday, and red would mean that the implied volatility was lower than yesterday. Now that could give us some clues in terms of, am I looking for a change in implied volatility before I come into a market? In other words, if I'm going to look to sell implied volatility, maybe I wait for the implied volatility to start to fall, or vice versa on the long. And then also, I just want to point out that this is the at the money implied volatility of the nearest monthly contract. And we have a lot of different expiration dates available to us every week. It seems like they, literally have some ETFs you have expirations one day away, right? So we're looking at the monthly contract or the monthly expirations. Rank, again, where is our implied volatility in a perspective of what it's been over a range over the last year. And then our percentile, again, is how many days above or below the implied volatility is compared to our current applied volatility. And then we get a high water mark. We see what is the highest implied volatility level. So it's an easy way to kind of just go in here and quickly look at the different stocks and the volume and the implied volatility. Now, for our idea, for what we're going to do is what we can do is we can resort this page by just clicking on the implied volatility percentage or ranking, depending on how we want to look at this. And I can go from highest to lowest or lowest to highest. So let's start from highest to lowest. Again, at this point as a trader, what are we kind of looking for? Well, we want to find where our rank in the percentile is high. Now, it doesn't always have to be 100%, 100%. It's just those are telling us that, today's implied volatility is at the highest. Maybe what I might be looking for is where we have just recently gotten from the highest and now implied volatility has fallen. Now, another kind of general rule here is, there are many different stocks for us to trade, but as an options trader or just kind of my own personal preferences, I kind of avoid any of the stocks that are below $10, especially those over-the-counter stocks, right? Because their volatility is very distorted. Here's one that's only a 29-cent stock, which has an implied volatility, could have an implied volatility of 600%. That's just, it's just not my game, right? So I'm not interested in that. But, just kind of looking at this from this standpoint, I see Target right here. I mean, that's a big cap stock, right? It's not going to have these crazy price fluctuations because it's only a 30-cent stock, right? But what do we see? Well, again, let's talk about that range or where implied volatility is. So yeah, is this implied volatility the highest Target has been? Is only 51%. Again, a lower relative high implied volatility. And today you can see, we're right off of that high, and we're just come off of this high. So this might be one of those stocks that I might be interested in looking at because it started to meet some of my criteria. So what I might do now is just kind of go through Target and look at some of the things that might be important to me. So first of all, if I just go to the price overview page, just below this main section up here, we get some options information. And so what we do see here is that our implied volatility is 51%. It's up a little bit today from it was yesterday, but based on our historical implied volatility, which is at 36%, it's telling us that, comparatively, we are at the high end. And if implied volatility starts to fall, there's probably a greater probability that it's going to return to maybe that historical mean. Now, again, our percentile and our rank, very, very high. And then you can see our range of our high to low. Now, what was some of the things that I said that could be influencing our implied volatility? Well, a potential price shock or our earnings. And you can see that the earnings for Target are going to be next week. So is implied volatility rising in front of this earnings? Yeah, I think that would be a safe assumption. But let's just go with the assumption that maybe earnings have already come out or just coming out. So what other things will I need to be aware of? So what I'll do is here under the options overview history, again, this is a premier feature. I can go back and look at where is my implied volatility and what has it been doing over, let's say, the last 3 months or the last 6 months or the last year or last 2 years. And you can see that in terms of Target, yeah, you can see our implied volatility is rising as we're getting closer to that earnings event. But, not too long ago, we were back at that historical, that 38, 33, 30. And so it does look like, Target kind of, fluctuates between high implied volatility to low implied volatility. And so that after the earnings, maybe in Target would go back to maybe more of a historical implied volatility. So this would be a great opportunity to look for selling implied volatility. So we've talked about some, cover calls and bear put spreads, bull put spreads in this case, selling. And we have videos that go into the details, but I want to kind of just look at more of the more complex ones, just to make it a little bit, show you if we can break these down a little bit. So what I'm thinking about here is I want to sell volatility. I'm trying to capture that premium. So I'm going to do something that is called a strangle. In other words, I'm going to, I want price to come in, right? I want that volatility to come in. So a short strangle. So there's, our screener here will give you a lot of different variables of price movement. Now I'm just going to pick one out here, down here at the bottom. Actually, let me go a little bit wide. Actually, you know what I'm going to do here? Let me change. I know what I did here. So this one is looking at implied volatility of, or excuse me, a short strangle of an option that's going to expire on Friday. And that could be part of our processors. Time is on our side, but let's give the trader, I'm just going to take the other side of our trade, some hope that they're going to be right. So the one I was kind of thinking about was, and I'm going to look at the chart in a second, would be something like the 175 call versus the 145 put. Now, why did I choose that? Stay with me. But right now, that would collect, $6.75. If I go back to that options that expired, on Friday, I'm not getting a lot of, these wider spreads. I'm not getting a lot of return, right? Now that might be your gain, but it's not really my game, so to speak. But if I look at a chart, what I kind of just looking at is, hey, let's make that assumption that earnings came out or it just happened. We got a little bit of a price movement today. Is the market going to settle down into this range? And that's what we would want to do. We want to see that the market is going to calm down and the volatility is going to calm down, and that we're going to capture that premium. But think about it in this terms. If I sold, let's say, the 175 and the 140 call on the upside and the put on the downside, is price going to stay in that range? Well, you can see since July, the price is stuck in that range. So will the price stay in that range over the next, let's say, 30 to 40 days? I'd probably say that's a high probability. And what we're going to do is we're going to pick up about $6 of potential profit. And we'll come back to this trade in a moment. So, sometimes when we are doing this process, we get a lot of opportunities, right? Or maybe our data field is pretty large. So, any kind of a data field that we give you or any of our pages, you can screen. Now, what I did was I set up a screener, and this screener, really, what I'm showing to you, there's no secret sauce to this screener, right? All I did was I just wanted some data points to do some referencing. And those data points would be similar to the ones that are on the main page, the rank, percentage high. I just added the percentage low. And the only filter here that I'm using is total options volume. So I just put a threshold of 20,000. Again, every trade is going to be different. Large cap stocks are going to have more volume than, let's say, medium or small cap stocks. So again, it depends on the trader what that volume. That's the only filter that I'm putting in here is this volume filter. And if I look at that result, notice what it did was it just knocks it down to those securities that have a little bit more volume. And again, what I just did was I just created this filter that's just going to give me these static points, right? So now what I can see is I'm going to go back to that high implied volatility percentile, and now I have that reference, right? That, what is that range? Where's current implied volatility, right? And then again, where is price fall, our implied value falling in that range or that rank. So again, if I'm looking at these high implied volatility stocks that have a lot of volume, again, these are going to be a little bit more liquid, right? It's going to be a lot bit easier for me to get in and out of. Now, the one I'm kind of interested in here was this utility software, right at the top here. Now, why am I interested in this? Well, because the year to low was 52%, and the year to high was 137. So a large range of implied volatility. The other thing that I noticed about this one is that current implied volatility is off of the high, right? Our rank has now fallen, but our percentile is still high. So this could be another trading opportunity. Again, I want to go into my stock and maybe look at that quote overview. Now, what do we see? Well, first thing we notice right away is that earnings either came out this morning or they're going to come out tonight. So again, selling implied volatility from an earnings event. Now, this stock is down 10%. That kind of telling me, didn't look it up yet. That's probably telling me that this stock's earnings already came out. So could we see a volatility crush after this big price movement today? Yeah, I think that would be a good assumption. Now, if I look at my options overview here, well, what do we see, right? Here's our range again. Our historical is at 69. So is there room for us to return to a more historical level for this implied volatility crush? Yeah, definitely. And if I go and look at my options overview history, right, we saw implied volatility rise going into the earnings, and only back in September we were back at that historical level. So this would be a great candidate for looking to sell implied volatility, again, doing a strangle. Now, again, I could do this one based on just a very short period of time, right? Here is current price trading around 21.50, and let's say we do a strangle where we sell $25 and excuse me, we're going to short strangle. We'll sell, like, let's say $25 and sell the $20 put. I don't know what we're going to get for that. Let's see. Well, we're gonna get close to $2. So here would be a trade that we could do where we could pick up $2 as long as this stock doesn't go too ballistic on the downside. I mean, it already made a 10% movement today, right? So the price shock is already in the market. So this could be a good trade for just 2 days to pick up, a $2 trade. And again, if I look at my break even, right, that $2 I collect, below $18, I'm at risk of losing money, and above $27. So I might go to my chart. Whoops. That with me. And look to see where this stock is going. Now, it's moving in, looks like new territory, but how far could $20 or $18 give me protection over the next 2 days? That might be a trade that I'd be looking at. And $27 certainly looks like it would give me enough protection on the top side for 2 days, right? So what could I do? Well, we'll look at some other tools that we can use in a moment. All right, so let's go back to our implied volatility page. And again, we can screen on that implied volatility, but let's go and look at this from the long side. In other words, low implied volatility. Now, if I go to the low to the high, I don't get a lot of lows right now, but Occidental Petroleum would definitely be interested in me. Good volume. It's a stock that I'm familiar with. And, look at my range, right? 40% to almost 90%, 89%. We're at the low in terms of our rank and applied volatility. Again, I'm going to do that process of looking at my historical and my implied volatility. And what do we see? That our implied volatility here is at 47%, but our historical is at 40. So I'm thinking about buying implied volatility, but my implied volatility has already gotten above my historical. So is this a good candidate for us? Maybe not, right? Is there potential for implied volatility to increase? Certainly, right? In terms of this range between 44 and 89, but maybe we could find a better candidate. Okay. So let's do this. Let's drop the volume here by, let's make it 5,000. Oops. And again, I'm going to do that filtering process where I just want to know which ones are on the low end, right? And the one that jumps right out at me here is Pfizer, okay? And again, look at our range here. Again, what did we say? A small range, maybe not a lot of great opportunities, but let's walk through this process, right? Our implied volatility is at the low end of our range. We don't have a lot of price movement on this one, volatility movement, but this might be a better candidate, right? So again, right, our implied volatility and historical are right there together. But at least at this point, if we do get an increase in volatility, there would be some room for it to go, right? And I might go back to my chart and look to what's going on here. And what I might say is, hey, I see that Pfizer's kind of lost its momentum. It's not really moving one way or the other. Or is it gathering energy? Is it gathering energy to break out above, let's say, $48? Or is it gathering, is its momentum trading? Is it about to pull back to like $44? So I'm going to make the assumption that volatility is going to increase and that this price, I don't know which way it's going to go. I just know that Pfizer is going to move, right? It's going to break this trend line, right? Or it's going to break out of this area of resistance, right? That's my assumption, right? So let's look at a straddle, right? So current price is around $47. Again, now if I'm going to buy probability or volatility, I want to give time, right? So I'm going to look a little bit more time. Let's go out to January. And, if I look at the $47 call put, let's go for the long, that would help. $47, it's going to cost me about $4.50. So what I have to think about is, can this stock move in terms of the stock price 10% between now and January to help me make money? Now, along the way, if implied volatility increases, then that's going to also benefit or magnify my potential. So what I'll do is now say, well, is there a probability of price moving 10% over the next, let's say, what is it, 2.5 months? So I can go back to the performance of this stock, and you can see that, over, the last month, it moved, about 4.5, 5%, right? So that would give me onus that say, hey, maybe, yeah, this could move. The other thing that we'll look at on potential price movement under technical analysis is, something called average true range, which is another measurement of volatility. And this telling us that this stock moves, Pfizer moves from high to low on an average daily price movement, not in directionally, just up and down about $1. So we are trying to capture a $4.50 movement between now and January. So my kind of general rule on this one is I like to see where my implied, if I'm going to buy implied volatility or buy one of these straddles, I want to be in that kind of that 3-to-1 ATR to the cost of the straddle. So this one is a little bit outside of it, so I might not take this one. But again, this is just a rule of reference for me, right? And you might find that 4-to-1 is okay for you. In this case, that's what this one would be. All right. All right. So that's kind of just the basics of how we can start going through the process of looking at implied volatility, how we can sort it, and then also, just doing a very simple filtering process to look for those candidates that have a little bit more volume, a little bit more liquidity, a little bit more ease for us to get in and out of trades. So the next thing that I want you guys to be aware of is that there are effects that implied volatility have on our pricing. And so there's a couple things that we need to be aware of. Well, there's a Greek that's called vega, and this is the change in the options price for a 1% change in the volatility. So if volatility increases, the price of the option increases. If volatility decreases, then the price of the option decreases. Now, all things being equal, in other words, time doesn't change, strikes don't change, price doesn't change, the stock price doesn't change. We're just talking about a change in volatility. Vega just tells us how much that change is going to be. And the other is delta. And delta is the change of the option for every dollar move up or down in our security. But delta also represents a percentage of probability that the strike price that we choose will expire in the money. So in other words, if I have a delta of 50, the market is telling us that there's a 50-50 chance that that strike price will finish in the money. So in high implied volatilities environments, actually lowers the probability of an in-the-money strike expiring in the money. In other words, decreasing the delta. And in a high implied volatility environment, increases the probability of out-of-the-money strikes expiring in the money. In other words, increasing the delta. So what does this mean to me, right? How do I use all this information? Remember we talked about the range of our probability, right? A larger range where we're going to look for those opportunities. But if we start, that range starts out at a high level. For instance, I think it was that stock, that software company, the symbol was U. It was 75 to 136. What this is telling us is that the market has already priced in these fluctuations. And so that if I buy implied volatility on a low rank or percentage on a stock or security that already has a relatively high range, then when price moves, I'm not going to get a lot of bang for my buck. In other words, it's going to mute my profits. So I want you to be aware of this, that if you are buying volatility in a high volatility environment, now this could also be a high volatility environment of the broader market as well, that those strategies where you're buying into volatilities, those bull call or bear put spreads, they're not going to appreciate as fast as they would in, let's say, a low implied volatility environment. And also the fact that the Vega, that range, right? The more the Vega can move, right? The greater the potential for price of our options to either increase or decrease. So let's go back to our two strategies I just went through with you. The straddle, where we're going to buy implied volatility. Now, we can make money in two ways here. The underlying moves enough in one direction to exceed the cost of what our straddle is going to cost us. That's called our break even. And if implied volatility increases quickly enough to overcome that deterioration effect of time decay, theta, which is another Greek that we've talked about in the past. So I just can't say, or I can't say that I think that prices are going to go up or down by an X period of time, let's say the time between now and the expiration of the options. My decision needs to be based on some statistics. Again, that past performance and another measurement of volatility, which I kind of hinted was that ATR. So again, if we looked at that Pfizer example, let's go back to that Pfizer example where we're looking to buy volatility, buy a straddle that is going to cost us, give us a little bit more time. It's going to cost us $4.50. And I look at that technical analysis, ATR, which is a measurement of volatility as well. I have a 4.5 to 1. Again, that reference I said to you, I kind of want to be in that 3 to 1 level. The other thing that we'll need to be aware of when we're buying these straddles is I have to be aware of these Greeks. So Vega, again, how much is our option going to appreciate or depreciate with a change in volatility? So what I do the first assessment here is I want to see if my Vega is greater than my theta. In other words, I'm going to get more appreciation in my strategy as volatility changes, and I'm not losing money for every day that I'm into this position. So that would be the first analysis that I'm going to look at, that my Vega is greater than my theta. Now, in the opposite, if I'm selling implied volatility, well, I want to see my Vega to be less than my theta. I want to see that theta decay. I want to see that option whittling away. The other thing we need to be aware of is delta. Now, not in the sense of how much is my option going to appreciate or depreciation for every dollar movement of the underlying, but when we do a straddle here, we're going to look at deltas of our long call and our long put. And you can see here, for instance, the $47, let's say that we did the $47 straddle, that our delta here for the put side is 0.455, and for the long side, it's 0.545. So we need to be something what is called delta neutral. So one of the easy ways to do this process is we just take the lower of the two deltas, in this case, 0.455, and we divide it by the higher of the two deltas, 0.545, and that's going to give us a ratio, 0.83. So what I want to do is I want to do enough contracts in terms of buying this straddle where I'm going to get to a delta neutral. In other words, I'm going to have to probably, in this case, buy more puts because the delta is less. So you kind of have to eyeball this one. But if I bought 6 puts versus excuse me, yeah, 6 puts, excuse me, 6 calls versus 7 puts, that would give me 8.5. So it's probably what, 6 to 5? Yeah, 5 divided by, excuse me, there it is. 5 divided by 6 is our 8.3. So I'd have to buy 5 calls to every 6 puts to be delta neutral. All right. So let's talk about strangles. And, the mechanics are basically the same thing, but, we're going to look at it from a different perspective. Now, the one that we were looking at this morning, or we just did in our example, was Pfizer, right? I think it was Pfizer. Oh, no, it was Target, excuse me. Target, yeah. So again, let's look at our strangles, short strangles. And I said we wanted to go just a little bit, not too far out. And I was looking at, what were we looking at? The 175, 140, right? We're going to pick up $6.79. And what's our break even here? 133, 181. So, I mean, we got a lot of room for price movement here for in terms of our market. So let's go to our chart. And when I'm going to strangle a market, well, I can use another measurement of volatility. And that one would be called a Bollinger Band. Now, what is a Bollinger Band? Well, a Bollinger Band is a statistical standard deviation of a moving average. In the case of this market, would be a 20-day moving average. Now, Bollinger Bands are 2 standard deviations. Historical implied volatility is 1 standard deviation. So what we're doing here is we're kind of making an assumption, as long as the market stays within 2 standard deviations from where I enter into this trade, then I should be okay in terms of my strangle. So you can see that outside of 2 standard deviations to the upside of current price would be 171 and 147. Well, we were going to do the 175 call and the 140 put. So those strikes are way out of the money, outside of our 2 standard deviations. So again, think about the monies that we're going to bring in and the probability that price is not going to get outside of these 2 standard deviations. And I will tell you that you can anticipate that gains will become much quicker when you see a decay of implied volatility versus our decay of our theta. But let's just kind of look at that. So we're in the the 175 call, right? And so here we're getting, not the theta is not decaying faster, but you can see that for every change in my volatility, it's around 1.3, right? A much more greater price impact with a change of volatility. I want that volatility to come in. I'm going to get more of an impact. Okay. So I'm just checking my notes here. I want to make sure I got everything I want to get in before I take a couple questions. Actually, I don't see many questions coming through to today, Gene, right? Or is my screen not working?
No questions coming in yet, John. No.
Okay, maybe I'm explaining it really good. I don't know. Oh, all right. So the one final thought that I wanted to give you in terms of selling volatility is that we still need to do some of that diligence. And one of the diligence that we're going to look at is if I see rising volume in terms of not volume necessarily in the stock, but definitely in the stock, but in the options. If I see rising volume and I see rising volatility, that might be a cautionary tale for me, right? Might not be a good time for me to sell implied volatility. My prudence would be let's sell or wait for the volume of the options to start to drop, right? Again, that post catalyst event, right? Not the rise of options going into an earnings, but afterwards, right? You know, you might give away a little bit of profit, but you're going to gain a greater probability. Now, the other caveat on this option concept is if you are looking at an option or the underlying stock and options prices are getting to those high implied volatility levels where we are determining that they're expensive, and you go and do your due diligence and you can't find a catalyst, right? There's no earnings coming up. There's no dividends coming up. There's no news story, right? That is kind of telling you that there's something going on in that stock. And where we might see something that is familiar to you, so some of you have used our options pages, is in our unusual options page or unusual options activity. And sometimes, you know, insiders know something that's going on or some information has been leaked, and that's when you'll get those high volumes, high implied volatilities, and yet you don't see any catalyst, right? So, you know, go to your unusual options activity page and see if the stock that you're going to short, the implied volatility is on that page, and that again might be a cautionary tale for you. All right, so that was basically what I wanted to get through. So, oh, some questions are popping up. Thank the Lord. All right. So Gerard asked about theoretical price, and what he's kind of saying is, let's go to, let's see one of the ones that we have up. So yeah, so here it says theoretical, and that is based on, you know, all the inputs, all the Greeks put it together and giving you a value of where that option would be fairly priced. In other words, exactly where it should be priced. So let's kind of just look at this first one, this call here. The last price was $4.65, but the theoretical is $4.75. Now, usually, and this is why I really want to stay with those options that have a lot of volume, is now we're in the 11/11 weeklies, and we're looking at the 4250 call. So I'm looking at the pricing here, and again, the 4250, and what do we see, right? The bid ask is 70, 470, 480. So our theoretical is right in between. So Gerard, what you can do is you can know that if you're buying an option or if you're selling an option, that you want to be try to get as close as you can to theoretical. But in the reality is, in some of these lesser volume options, that the bid ask will be pretty wide or wide enough where that you wouldn't be able to get the theoretical, that you might have to sell below the theoretical or buy above the theoretical. But it also just kind of gives you that guideline. So, you know, let's pretend that this was $4.50 versus $5, and the theoretical was $4.75. Well, maybe I put in an offer to sell at, you know, $4.70 or $4.65, you know, just a little bit below the theoretical. So I know that I'm not giving away a lot of value. So using the theoretical in terms of the bid ask can kind of tell you if you're overpaying or underpaying at the time. And again, the more volume there is, the less slippage you have and the tighter your bid asks are going to be. Okay.
Hey, John, as long as you're on the Pfizer options page, I've got a question from Andrew here. Go ahead and change your expiration to the January 20th monthly, if you could. The question is, what do those asterisks by the strike price mean? Do you want to take
That's
that?
a good question, Gene. Can you answer that one?
Well, yes, I can. So anytime you see an asterisk, those are what we call restricted options. They're not tradable, and they're typically created whenever there's a spinoff or a merger or something like that. So we show them on the options page, but those that are asterisks, you won't be able to trade.
So those would be like after a stock split or something to that effect, right?
Correct. Yeah.
Oh, cool. That's what I love about you, Gene. I always learn something new every time I talk to you about our webpage. So awesome. I appreciate that information. Okay, so we're at 2 o'clock. I do see that we answered most of the questions. The one that did come up.
Yeah,
So
the
let's
only other thing I wanted to throw in there, John, I did have a question from somebody about whether all of this data and the screening on implied volatility and the all the metrics that we have available, whether it's available with a free membership or not. A lot of this is requiring you to have a premier membership. And if you're not a premier member, we offer a free 30-day trial. So you could easily sign up for the trial, look at all of these different screeners, look at the IV metrics, and you'll see for yourself how valuable this information can be.
Good point. Good point. I'll show that in a second. So let's just finish up our thoughts here. Implied volatility is an essential component in determining the price of our options. We kind of learned how to look at implied volatility ranks and percentiles to give a trader a relative perspective if an option is cheap or expensive. But we need to be aware that implied volatility is unpredictable and that determining the right strategy requires that other due diligence, regarding our historical, the range of where our applied volatility is. Am I looking at a long or short-term option? And also that difficulty of predicting where price movement is going to go of our underlying security, using those things like ATR and Bollinger Bands. And then finally, implied volatilities would agree that understanding where the applied volatility is and placing your position on the right side of volatility is half the battle. Once you can get to that process, you're going to be a little bit more successful. Okay, so let's just finish up here. Upcoming webinars. Well, next week we're going to look at Bollinger Bands. Yes, this is one of my favorite techniques. One of the ones I use. We're going to look at Bollinger Bands in the classical sense, but we're also going to look at some adaptations of Bollinger Bands in terms of applying strategies. But we'll learn about the math of it. We'll learn about over and sold and overbought trading techniques. And then, I'm going to show you how I kind of use it, where you look at dailies to set targets, but I might use intraday timeframes to look for entries for my positioning. So come and join me for that one. I think that one will be a little bit more exciting than this dry, dull options one that we did today. Not that options aren't dry and dull, but I think the subject matter might be a little bit more exciting. Okay, the other thing I want to remind you is that on Fridays for our premier members, is what Gene was talking, is that we have a new segment called Market on Close. And one of the cool features that we do now is you can go to our Market on Close page. You don't have to sign up. You don't have to download anything, and you'll be able to access the Market on Close right from our website. And here you can see our countdown is coming. 2 days and 24 minutes and 53 seconds. I better get busy because I know that that's going to be an exciting session, and you'll be able just to click on here and access that through page. Okay. Anything else, Gene? Did I get it all?
No, that's it, John. And for all of you down in Florida, we're thinking about you, hoping everything passes through quickly. And Roger, you stay safe, okay?
Yeah, definitely. Everybody, keep your head down there. Don't let up just because the last one wasn't as bad as they anticipated, right? So I agree with you, Gene. Gene, thanks for making for a great session. Everybody out there, be safe, be healthy, and the good of all trading.